Sup? I made 120K last year, and here are the 3 rules I followed religiously to obtain that.
Yeah, got me in this party all up in the zone. Hottest Betty's trying to take away my cell phone. Like, come and party, I've been trying to shake you off my mind, but just can't.
Just some disclaimers first. My results are not typical and should not be expected. But if you do follow these 3 fundamental rules I lay out in this video, chances are you're going to see some drastic increases in your profits this year. Alright, number 1, risk management. This is rule number 1 because it is the most important rule. Do not gloss over this section just because you think you can manage risk. First, let's go over how to use risk management to determine your average entry position size. So people always ask me, Tobes, how many shares should I buy for this entry? And this should be directly based on your max loss per trade. Everyone should have a max loss per trade. This is the amount you're willing to lose maximum for this trade, right? If all else fails, this is the max I'm going to lose on this trade. So now that, for example, in this scenario, let's say our max loss per trade is $500, and I want to enter a position in this stock, ACY. And let's also assume we're currently at 1105, right? 1105 on 12/31st. And let's describe the price action so far. It opened, went straight up, hit a resistance, and then consolidated, flushed down a little bit, hit support, and then bounced back up again. And now it's about to break the previous high, the previous 5-minute high, right? So for a trader here, we want to enter a position here for the break of the high. However, as always, not every trade is 100%, and that's okay. What we need to make sure is that even if the trade fails, we don't blow up our account. We need to manage our risk. So through that, we want to determine how many shares we should buy, because the more shares you buy, the more risk you have, right? So what we know so far is that our max loss is 500. And then next, we want to know the average size of a red candle so far. So just in case it has a red candle, how much should we expect to lose if all else fails? Ideally, for example, we want to get out early. Like, if we have a red candle, we're not going to wait until all the way at the bottom to sell. That's, of course, especially for a breakout, because when a breakout fails, it's going to sell, right? You're not going to wait and hope it goes up immediately. It's going to go down and then consolidate for a bit and then bounce up, right? But having a max loss is just there to prevent blowing up your account and making sure that you don't over-risk your positions. So now that we have $500 max loss, we want to look at the size of the average red candle so far. So we have -5%, -8%, -5%, -8%, -1, -2. So let's just say the average is what, 7%, right? So if we do experience the worst case scenario, we drop 7%. So now we have 2 numbers, $500 max loss and 7% percent loss per red candle. So now basically you want to divide 500 by 0.07 from the 7%, and then you get $7,000 and $100. So $7,100. So this means based on your max loss, and this stock specifically based on its prior price action, you determine that your entry size should be around 7K. So this is how you determine your entry size. This way, even if we do hit this max loss candle, we're still not blowing up account. We're still restricting our max loss per trade to $500. This is how you make sure you stay consistently profitable. And next, let's think carefully here. The number 1 rule in trading should not be maximizing profits. It is all about minimizing your risks while profiting as much as you can. So never get blindsided by profits and end up ignoring your risk. Always pay attention to your risk first. So this means you need to diversify. Never all in and don't lose your account over one trade. And never overchase profits with leverage. While you can make a lot of money with leverage, oftentimes people ignore the fact that leverage also means you can also lose a lot of money really quickly as well. And people do end up blowing their entire accounts because they ignored the risk. So what are the other ways to manage risk? So far, we already covered how to set a max loss per trade and use that to determine our average entry position size. Other ways to manage your risk include setting a max loss per day, right? So if my max loss per day can be $2,000. If I lose $2,000 today, I'm gonna leave leave the trading platform. We're not gonna trade anymore if we hit our max loss per day. or the number of bad consecutive trades. Let's say if we have 3 losing trades in a row, it probably might affect our mental. And trading is all about mental. You need to stay mentally strong. If you hit 3 consecutive losses, usually for me, I leave and I don't trade anymore. So personally, once I have 3 losing trades in a row, I just stand up and leave the trading for the day. No questions asked. I either start playing games or go to a steakhouse. It doesn't really matter. Although in reality, most of the time I go on to make a 4th trade. Just to try my luck again and see if I can come back green on the day. But that's just me being stupid. Don't be like me. That's bad. There were a few instances when I was down 2K on the day, and I should have just stood up and left. But I ended up going back into another trade to try to get myself green on the day. Then guess what? I ended up losing another $1,000. Just like that. Like when Thanos snaps his fingers. I knew I was not in the correct mindset anymore, but I still voluntarily stepped back down and gave back another grand to the market. I mean, I just hate money. What can I say, right? So, the key to risk management is to be disciplined. You'll be surprised how easy it is to write down risk management rules for yourself right now. But when you're actually trading on the trading day, all of that usually goes out the window for most people. That's very, very common. You must stay disciplined, or else you will end up like 90% of the traders out there who lose all their money. Alright, rule number 2. It is exit strategy. The second most followed rule is having an exit strategy before you even enter a trade. When entering a trade, you must have already formulated an exit strategy. And there's 2 parts, stop loss and profit taking. Because this makes sense because when you sell, you're either selling for a loss or for a profit. So before you even enter a trade, you determine at which point would you exit a trade for a loss, or at which point would you exit the trade for a profit. You must know that before you even make the trade. So, stop loss means you determine a point at which you would exit, even for a loss, if the price crosses below the stop loss price. And this stop loss is usually determined by a technical analysis support line. For example, once again, we're trading the breakout on the 5-minute of ACY. And just disclaimer, you would never trade 5-minute for a stock like ACY because it's too volatile. You will trade the 1-minute chart probably. But we're just talking about the 5-minute just for the sake of this video. So, we're trading the 5-minute chart for ACY. You're looking to trade the breakout, right? So let's draw some lines here. Right, so right now, we're just going to say this is what the chart looks like, right? Imagine we're on 1105 on 1231. Wow, this is going to go. This might go for a break, right? So you enter a trade here. So, but before you even do that, you think, if I do enter a trade here and it does not break up, but it breaks down, at which point would I know is a breakdown, and at which point should I sell? So that's where you look for a support line. For example, we already supported through today's price action. We've already determined there's heavy support here because the previous resistance here is a support. It's a new support, and also this candle closed right at the previous resistance, which means most traders out there are going to be using this same line as support. If they cross below this support line, they're going to sell automatically. That's their stop loss. So you must have already identified this point before you even enter the trade. All right, my cat is coughing. Ignore that. Next, you want to determine your take profit line. So if you're trading in breakout, this is a special case, kind of, because you don't really have a profit taking line for exactly because stocks can always go up. So in this case, you want to determine at which point should I take profit off the table, because you don't want to hold the position all the way up because what if it crashes down? So let me demonstrate what I mean by this. So let's say you enter a position here, you already have a stop loss, right? So for stop loss, you can just, for example, use like this trading widget and then just type in a stop price, right? When you buy, just stop at, for example, 1101, right? But for example, if it goes up, right, you want to determine, so now this already broke out. So you want to determine how much profit you want to take off the table. And you do that before you even see this candle. You just see, oh, imaginarily, if it goes up, how much profit should I take off the table? The rule I use is per candle, I take off 25%. So for example, when we see this candle, now we're at 11:10 on 12:31, I take off 25% no matter what. And then we see the next candle. Oh, broke up again. Take 25% off the table. And then we keep doing that until this candle, right? And then we keep doing that until probably the fourth candle I wish will be out, right? But this just means that we're going to prevent the breakdowns, because if you hold a position all the way up, you don't have an exit strategy in mind before you even make the trade. You're going to be holding it here. You're going to be like, oh, it's going to keep going up, and then bam, it flashes down. And then after later, you're going to be like, oh, it's going to bounce, and then bam, it flashes down again. And then you lose all your profits because this is where you entered. So an exit strategy for this trade specifically would be to take 25% off the table for a breakout. This is usually what you do for a breakout, because a breakout can usually flush a huge percent in just one candle. So that's what I mean. So before you even enter the trade, you need to have an idea in mind of, if this goes bad, what would you do? If this goes good, what would you do? You need to have that already in your mindset, because if you don't, you're going to be sitting all the way up here, and then it's going to crash, and then you're going to keep sitting, and then it's going to crash down again, and then what could have been 2K in profits, you just lost it all, right? Because you didn't realize your profits. You didn't have an exit strategy for when it went up. You just kept holding, wishing for the best, but eventually it falls down. So my strategy is usually just to take 8% off the table per candle, just to make sure I realize my profits. All right, and also another note about stop loss. Remember when we talked about max loss earlier? These are different. Max loss is just the worst case scenario. You don't prevent the worst case scenario, but usually stop loss, you don't want to be risking 7% like earlier per trade, right? That's way too much. A stop loss is usually just a few percent at the previous support point, right? So even though your max loss is what, 7K, you don't want to win until then. If it breaks the support, you know everyone else in the market is going to be selling, so there's no point in holding, right? The max loss is just to prevent a flash crash like this. All right, now on to rule number 3. Rule number 3 is having small goals and separating individual days, weeks, and months into their own category. So, for example, with me, for each new week, I start fresh. So no matter how much profit I made earlier in the year, in the week, in the month, whatever, it doesn't matter. When I start a new week, I start fresh. I start at 0. And then I start counting my profit upwards. So for example, let me give an example, right? Examples are always easy to understand. Let's say an average person probably thinks like this. My account yesterday was 60K. Today it's 62K. I made 2K profit. Tomorrow I hope it's 63K. But no, you should not think about your account like this. Do not think about your account in terms of your overall account value, because this usually leads to more losses than you could have saved. So this is how I think about it. On Monday, this week, I made 3K. So remember, I started from 0. So now I'm plus 3K on the week. I don't think about my overall account balance at all. And then today, I made 1K. So that means I'm up 4K on the week. Oh, great. I have a 4K cushion now on the week. So even if I fuck up the rest of my week, I still have a 4K cushion. I can still go positive on the week. The goal is to go positive. It's not to maximize your profit again. It's to minimize your risk. And now my weekly goal is 5K. All right. Now let's get back on track and make at least 1K in the next few days. What's great about this thinking is that because I still have a few days left, and I only have 1K left until my weekly goal, because I think about my goals as weekly now, I have a bit of extra cushion to play with. That means I can take a bit larger risk than I could have, because I already made 4K on the week, right? This is why we separate it into weekly. So what I did here is that I did not think about my account as a whole, but instead I separated my thinking into weekly intervals. I started the week with 0 and have a weekly goal, and throughout the week I try to think in terms of the week, not the overall account balance. Because it could be like, oh, I'm at 62K today. Tomorrow I hope it's 63K, but tomorrow you go down 4K. Bam, that's a huge loss, right? But then you think about your overall account value. Oh, I'm still at 59K, it's not too bad. But no, that's bad. You lost 4K. So when you separate it into weekly, you can think about things more clearly, and then have separate weeks where you can be like, oh, this week I made 5K, next week I made 2K. This week I lost money, but that's okay. You know, that's only isolated to that week. So, all right, that's it, guys. These are the 3 golden rules I followed for every single one of my trades in 2020 that led to 120K in profits in just 1 year. It's pre-tax, but whatever. It's 120K, 120K. So, at the end of the day, remember, that's a summary. 1, manage your risk. Don't overchase profits. Manage your risk. That's number 1. Number 2, have an exit strategy before you even enter a trade. And lastly, number 3, have weekly goals. Think about your account by the week, not as an overall balance. That's not good. So that's it, guys. Remember to like, comment, subscribe. And if you're wondering what brokerage I'm using, what platform I'm using Webull. This is a desktop platform, and you can sign up for free. Use it for free. And if you do sign up, remember to use my referral link, because if you use it, you get $100. If you don't use it, you don't get $100. Free $100, free money. Always take free money, even in the market. So that's it, guys. Remember to like, comment, subscribe, and I'll see you next time.